Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner, and founder of Menninger Associates Financial Planning. I'm pleased to be joined here with Kyle Ryan, also a certified financial planner as well as a chartered financial consultant, and also one of the equity owners and largest equity owner partner of the firm outside of myself.
Outside of the one speaking. Thanks for having me, Mike.
But anyway, thanks, Kyle, for joining. And so this is the next in a series of responding to questions and answers that are questions, shall I say. We did a internet search, so to speak, with AI.
Yeah.
And most commonly asked questions, because one of the things I struggle with all the time here is what can we talk about next? And what better than to answer questions that
Right from the internet, what people are wondering.
Exactly. And it came from the internet, it must be true. Anyway, so the concept is that we ran all these through AI, ChatGPT or wherever the heck we got it from, all these questions, and then we sorted them by subject material. And so we're on the fifth part of this series, of which the first one was just general questions and answers about financial planning. The second one was retirement planning, because a lot of those questions led into it, and it was a nice flow. Third one, we talked about debt management. The fourth one, we dealt with risk management and insurance planning and different insurances. And where we're picking up now, which is almost certainly going to take 2 episodes, were questions on investments. So the final segment of these, or the final part in this series, will be on tax planning questions. So you ready to kick off?
Yep.
Absolutely. All right, perfect. So I'm going to read the question, and we didn't even talk about who's going to tackle it, so we'll just play it by ear.
We'll take it.
So question number 1, what is the difference between stocks, bonds, and mutual funds? Well, I'll tell you what. Here's how I would say we start with the difference between stocks and bonds, and then we'll talk about mutual funds because it applies.
Yes. Yeah. I mean, stocks and bonds can be owned individually in mutual funds, so they're almost a little bit exclusive. But starting with stocks and bonds, stocks are when you own something. Bonds are when you are lending something. So if I give you $1,000 and you're going to pay me 4% interest back, that is reminiscent of a bond, right? If I own a stock, I give you 10% of what your company's worth, and your company's spitting out dividends and its growth, I get to participate in that growth. It's a little bit more risky because there's really no guarantees on the end of it, such as a bond fund can typically hold. Can't really use the capital G word, but usually you can expect income from bonds more so than you would stocks, unless it's dividend paying.
The long and short of it, too, is, to Kyle's point, stocks, you own a percentage of the company.
Yes.
Bonds, you're lending to the company, and they're promising to pay you back later. And I think we could spend a little more time on the description of these. And I know that I have what I would characterize as a decent description on bonds. But the thing that people get afraid of is, I'm going to lose all my money in the stock market. And, the reality of the situation is that the only way you could lose all of your money in the stock market is if every company in the stock market literally went to zero, which basically means I hope you have a really good garden in the backyard, because your car's not going to work because you can't buy gasoline. The grocery stores aren't going to be open. There's nothing open.
And capitalism, democracy is gone. It's anarchy.
Right. You're not even that. You're basically living off the land. You're taking yourself back hundreds and hundreds of years, where you darn well better have assets, hard assets that you can live on and stuff. So, but individual stocks, again, are owning a percentage of the company. And if the company does really well, so will you. And if the company does poorly, well, so will you. And you'll have a lot more volatility in that. And if you take a look at the long-term rate of return of the stock market, is somewhere between 11 and 12%.
Yep.
Okay, well, 11 or 12%, yeah, it's a nice rate of return, but it becomes the law of compounding is when it really rears its head over the long term. And if you were to take a look at the rule of 72, where you take 72 divided by your average rate of return, it tells you how many years until your money doubles. Well, if stocks are at 12%, rule of 72 means your money's going to double every 6 years. You give that 24 years, you put $10,000 into stocks. If they earn 12% over 24 years, you got yourself $160,000.
Yep.
That's not a small number compared to lower rates of return, 3%, your 10,000 becomes 20. So that's the advantage that stocks provide. But obviously the disadvantage is we all remember 2000, 2008.
2022, it wasn't as bad, but negative years. Yeah.
Right. And, even during COVID.
Yep.
Stocks dropped 35% in 5 weeks.
Yes.
Okay, so for those who do not have a strong stomach, then stocks may not be your right thing to be in, but at the same time too, that's where the most opportunity is.
And when we say stocks average 12%, let's define that a little bit. It's the S&P 500, which kind of gets into the question of mutual funds, ETFs, indices, which can track, depending on the variation of it. But the S&P 500 tracks the 500 largest companies in the U.S.
Right.
Those historically have averaged 12%. That is an index comprised of many, many stocks, 500. Roundabouts. But an individual stock, there's no really guarantee of its performance, right? An individual stock, getting into the difference of a stock versus a mutual fund versus an index, you name it, is one stock. You do what that performance does. When you own 500 stocks, you'll get the average performance of whatever the weightings is there. So that's why when you say the average performance of the stock market is 11, 12%, that's the S&P 500.
Right.
Individual stocks are entirely different. You go back to the early 2000s, there's only one stock that has outperformed the
Since
S&P
1999.
500. Since 1999, there's been one stock on the S&P 500 that was on the S&P 500 then.
Top 10
then that has outperformed the S&P 500 to this day. So, it leads to kind of the next topic of
diversification, but we're still not even there yet. So the where you were going with that is, people look at today, and we've all heard of AI and the Magnificent Seven, and those stocks are going to do nothing but go up forever because that's all they do. Well, the same was said in 1999. All these technology stocks, all they do is go up, and they're going to continue to go up and everything else like that. Well, we took the top 10 largest companies in 1999, and only one of them between then and now outperformed, and only one of them happens to still be in the top 10.
That's right? What it is. Yeah.
It's Microsoft.
Yes.
But we're not recommending Microsoft by any stretch of the imagination. It's just a example. And while we're on examples of stocks that can go up or down, let's take a look at the darling, and that's the one we talked about beforehand. We're not here to recommend stocks by any stretch of the imagination. We're only representing examples of history. Yeah. The darling of the 60s, the 70s, into the 80s, the darling company of the world. GE. Okay. GE, was the leader in the world for decades. And then as it approached 2008, one of its units was GE Capital, was in the financing piece, which is what really took a dive in 2008. And what we saw was GE, which was, one of the best stocks and best companies, one of the best companies in the world. The stock is owning a sliver of it. All of a sudden, GE went from 60 down to 6 and never fully recovered.
Yeah.
And that is an example of an individual stock that gets beat up. And, if you own, and I know a neighbor who, everybody around here, not everybody, but a lot of people around here, there's a few large GE facilities. Those are the people that lived all those years. They accumulated all that stock. They retired with all that stock, held all that stock. And next thing you know, the value of it is a fraction of what it was before, which goes to diversification, which I'm sure some of the questions that are coming up. I use another example, Enron. Good example, bad example. Enron was actually number 6 on the S&P 500 in 2000 or 2001. And what it basically was a house of cards. And once they realized that there was a lot of cooking the books, so to speak, Enron literally was number 6 in the S&P 500, dropped to 0, which is why, any individual stock, anything can happen. But if you own the S&P 500, and theoretically, if it was 1/500th of the S&P 500, the concept of losing one of them, you still got the other 499.
Yes. Yeah, that's where when people say, hey, if the stock market collapses and it goes to zero, that is one less likely instance. Whereas if you own an individual stock, you can have real conversations about
Correct.
what if this thing goes bankrupt and it doesn't continue to succeed.
Correct. And that's why it's very important to understand that stock and stock market are two very different things. So let's talk about bonds. Bonds basically are an IOU to a particular company. And the way a bond works is they're loans, like you said, and they come in $1,000 denominations. So when a company issues a bond, what happens is that they'll issue bonds in $1,000 denominations, and they have a finite period with which they're mature. Okay, so let's say, for instance, Apple. Okay, Apple as a company decides that they're going to issue a bond. And what they do is they say, all right, we want to borrow $10 billion. So they'll issue $10 billion worth of bonds. So investors out there, including people like us, we could buy a $1,000 Apple bond. And it says, all right, it has a coupon of 5%, which means that on my $1,000, it's paying me $50 a year. Okay? And then at the end of 20 years or whatever the defined period is, they give me my $1,000 back. Sounds like a fair deal. Except for one thing. If the company goes bankrupt, there goes my $1,000. Okay? And so, interestingly enough, that then lends itself to, well, Apple, considered to be one of the few Class A rated companies for bonds, can get away with offering an interest rate that's marginally higher than what you can get from treasuries, which are considered to be the safest investment. Whereas if you took a smaller company that didn't have as good a credit rating, in order to entice people to buy their bond, they may need to provide an interest rate of 9%
Yes.
or 8%.
Yep. And you could even, use it as, again, using it as a loan. If Mike is issuing a bond and he's got millions of dollars to back it up, chances are there's not a lot of risk of him defaulting on that bond. So he can offer, as an investor, I'm willing to accept a lower interest rate because it's not a lot of risk. Now, if Mike's going to go get a bond from me, and I don't have a lot of assets behind my name to speak for it, he might desire a higher interest rate on those bonds because of the risk he's taking. So sometimes when you have a bond fund or a bond fixed income in general, risk can tend to lead to a higher rate of return or an interest rate.
Right. Because if I'm like, there's no way I'm lending you $1,000. He's like, all right, well, I'll sweeten the pot for 9%. I was like, all right,
Yes.
I'm willing to lend you $1,000 if you're going to pay me 9%.
Yes.
So why do the value of bonds fluctuate? So this is where they're very similar to a CD in that they spit out certain defined interest rate for a defined period of time. But where they differ from CDs is that the value of a bond could go up or down. So take, for instance, if I said Microsoft, I buy this Microsoft bond, then I give them $1,000 and it's going to be paying me the coupon rate of 5%, means they're paying me $50 a year for the next 20 years. Well, how am I feeling about that 5% bond if the going interest rates are 10%? Not very good about it, okay? And therefore, what's going to happen is if interest rates rise, the value of my bond goes down, because why would you buy that bond that's paying 5% if you can get right out in the open market?
Yep.
So that'll drop the value of the bond. Similarly, if the interest rates drop to 1%, boy, I'm feeling awfully good about that 5% bond.
I always love the very simple illustration of just think of a seesaw. On one end of the bond market, you have the price of bonds, and the other end, you have the interest rates. If interest rates go up, price of bonds goes down, and vice versa. It's a really easy concept. That's why when you think of stocks, there's a lot of, and how the stock market versus the bond market works, they say the bond market's the smarter market. There's a lot of emotion that can go into the stock market, whereas the bond market, what are the first two letters of bonds? Boring. Usually you can, it's not that you can ever predict the market behavior of the bond market, but it's a little bit more, it's typically less volatile than that of the stock market, because it really is interest rate dependent more so than the stock market would be.
Well, yeah, and so the other thing too, to Kyle's point about being less volatile, we've seen movements of the stock market of 2 or 3% in one day. If you saw a 0.5% move in the bond market in one day, that's huge.
historically, lately times have been a
Well-
lot of volatility in the bond market these days.
So the other thing that can impact the value of bonds is it doesn't respond to interest rate movements the closer you get to the maturity.
Yes.
So if it's really close to maturity, interest rates move up or down. Well, my $1,000 bond is going to be paying me my $1,000 back in a month. So the movement of interest rates aren't going to really have much of an impact. So now let's talk about mutual funds.
Yeah.
So you referenced the S&P 500 is like a mutual fund, but it's an index mutual fund. So all a mutual fund is a basket of stocks. Now, typically mutual funds are either passive or active management.
Yes.
An index fund is typically passive, which means they're buying the 500 S&P stocks and they're done. Okay, or they're buying the S&P 500 index and they're done. Whereas an active mutual fund, they may look at it and say, boy, I don't want this Enron thing. You know, it's nothing but a house of cards. The active manager will say, I don't want that one. But they may look at, back then, Cisco. Cisco may have been an outstanding investment. And they may say, well, Cisco's maybe 2% of the S&P 500. We want to have 4% in our investment fund. So what happens is that the manager of the mutual fund actively manages it, is now really making decisions as to how much of a particular company stock that they want to own, how much they don't want to own. And because of their clout, because of their size, they have the ability to pick up the phone and call Mr. Merck and Mr. Pfizer and Mr. Johnson and Mr. and Mrs. Johnson and to be able to get a meeting with them to talk about opening their books because they're talking about investing millions and millions of dollars.
Yes. Yeah.
So the mutual fund also allows you as the individual investor to be able to say, what if I wanted to buy the S&P 500? For me to buy every one of those 500 stocks, number one, it's going to cost me a fortune, probably close to $10,000, just at least.
An old ticket.
At least, not to mention ticket charges. Okay, so if it cost me $10 each to buy a stock, well, it's going to cost me $5,000 to buy the S&P 500. Plus, if I add up the price of one share of every one of those stocks,
It's a lot of money.
it's a lot of money. And then it's also not evenly weighted because if one stock is $400 and one stock's $40, I'm buying more of this one than I am this one.
Yeah.
The beauty of a mutual fund is it can allow an individual investor to go in there with as small as $100, $250,000
Yep.
to just buy and own all these stocks.
And the landscape around that has changed a lot in the last few decades, where if you wanted an exposure to a basket of stocks and have true diversification, a mutual fund was really your only method. And traditionally, it was really, I believe it was mostly passive mutual funds. The days of, active mutual funds. The days of passive mutual funds, passive ETFs, which we'll get into, are newer. Because think about it, if you have a manager doing all of this work on your behalf so that you can invest easier and ideally have better performance, they're not doing it for free, right? It's called an expense ratio. So whenever you have a mutual fund, an ETF, as opposed to a stock, an individual stock, you'll typically pay an expense ratio which pays the management company for issuing that fund and managing it for you. So when you have an active manager, they're going to charge you a little bit more than would a passive manager who may or may not be, likely is doing less work simply to track the index or whatever they're trying to achieve in that passive mutual fund. So active mutual funds typically are more expensive, but that has really been coming down a lot. You think back to 30 years ago, 20 years ago, you'd have an active fund manager call up these companies. I want a meeting. I want to understand what's going on in your company because we've got hundreds of millions of dollars to invest in you, like you mentioned. The world's kind of changing now where a lot of this information has become more public. So these passive indices recently, every year is different, but recently these passive indices and passive mutual funds can, over the long term, outperform their active counterparts. No guarantee of it either way, but...
Hey, by the way, did you realize that we spent 18 minutes on that?
On one question.
On one question. So if we're going to go through 10 questions, 180 minutes, that's 3 hours.
Yeah, we got it.
So I tell you what, it makes her a perfect opportunity to take a break, and we'll be back with you for the next questions. Thank you, and we'll be with just a few moments.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained, and we're picking up. We just spent almost 20 minutes on one question. I think we got the idea. So we talked about the difference between stocks, bonds, and mutual funds, which, and I'll even go one step further with mutual funds. With mutual funds, and you were talking about active mutual funds, passive, same thing. Within mutual funds, you have the ability to say, I want to be a little bit more specific with my mutual fund. I want to go ahead and buy nothing but international companies, nothing but emerging markets, nothing but large cap growth type of companies, nothing but small cap companies, nothing but healthcare, nothing but energy, nothing but commodities. So that's what also gives you the ability to target a specific sector. And that's another thing that mutual funds give you the ability to do. As an individual investor, if I had only $500 or $1,000 and I wanted to diversify within within a sector, it gives you the ability to do that.
Yes. Yeah. And ETFs are very straightforward. They're very similar to mutual funds in that they can be a basket of stocks, a basket of bonds. The only minor differences between ETFs and mutual funds is an ETF can be traded throughout the day. So a mutual fund, you buy or sell a mutual fund, it's going to happen at the close of the market, right around 4 p.m. Eastern time. Whereas an ETF, you buy it at noon, you bought it at noon as long as your order gets filled. And you can sell it liquidity in the same day, in the same trading day. So that's one difference. Other than that, there's really, between ETFs, mutual funds, they're very similar. It's just a way to diversify with less dollars.
Okay, so now you know what the next question is?
What does ETF stand for?
No, okay. So the next question is, what are ETFs and how do they work?
Yeah.
So basically what Kyle said is that they're the basically equivalent ETF, exchange traded fund. Yes. Fund, mutual fund, exchange traded, which means instead of it paying at the end of the day, whatever the value is, and they collectively add up, and a mutual fund usually has 100, 200 different individual stocks in it, is it'll take the value of the stocks at the end of the day. And to Kyle's point, an ETF could be traded during the course of the day. You hear that, someone just dropped a nuclear bomb, you want to quick get out of it. You could do it at the beginning of the day or in the middle of the day. But
markets are freezing before you get a chance.
I know that. Well, I knew it was coming.
Yeah. There you go.
There you go. Insider trading.
Yeah, it's like when you're on the plane and it flies off and you short the company.
All right. Anyway, next question is, what is asset allocation and how does it affect my investments? That's actually a good question. You want to pick that up?
Yeah. Asset allocation is really, to answer it, it's how you allocate your assets. So if you have an investment portfolio, what sort of composition is your portfolio made up? Are you 100% stocks, equities? Are you 100% bonds? Are you a mixture? Most likely a mixture, depending on the amount of risk you want to take. So asset allocation and how it affects your investments is really how it can affect your performance as well as the volatility. Historically, stocks are more volatile but have a greater rate of return over the long haul than bonds do. Bonds are typically less volatile. So you'll see, based on your risk tolerance, which can be based on how much time you have, will typically depend how you allocate your portfolio. If I'm looking at a retirement account for myself, I've got 30, 40 years before I'm even going to dream of touch it, my asset allocation could be considered aggressive because I have got time. I don't have to sell things if it goes down. If I have money where I'm going to go buy a house in the next 2 years or 3 years, I'm not going to go invest it. I'll have it be cash. I'll have it be really conservative bonds because I'm not taking the risk in the stock market in that short amount of time.
And the other thing that asset allocation does is it, as a rule of thumb, you got a basket of eggs. Not all of them go up or not all of them go down at the same time. So the concept of asset allocation is you're diversifying your risk. And I remember seeing a question about that, and it's probably the next one. But you're spreading your risk out. So for instance, if you had 70% stocks and 30% bonds in your asset allocation, if stocks do really well, trust me, you're going to look at your bonds and say, I hate these darn things. But if the stocks go down and the bonds go up, you're going to look at it and say, hey, I like my bonds. They protected it. So even from there, asset allocation, you might have some international stocks, you might have some domestic. And international, for one reason or another, may outperform or underperform the United States. But what it does is it provides some level of smoothing out the the volatility.
And depending on your risk tolerance, your interest in investing, where you want to have your money, you can get into commodities. There's private investments. There's a lot of different ways outside the typical stocks and bonds that you can curate a portfolio to match the amount of risk. That's really where you want to start, is what sort of risk do you want to take, and then how do you build the portfolio around that?
Right.
And risk comes from what's your goal? What's your time horizon?
Right. Yep. Very good. Next question was...
They're all out of order.
Here we go. What is diversification and why is it important in investing? We just kind of said that.
Yes. Well, the most, not that I agree with, the most famous investor of all time, in my opinion, is Warren Buffett. And he basically says diversification is protection against ignorance. Not that I believe it, not that that's something that we spout, but basically when you diversify something, you are hedging your risk, right? So why do I bring up the Warren Buffett quote? Because Warren Buffett he's the reason he's the most successful trader of all time, the most well-known trader of all time, is because he has like a over 50% hit rate. The guy, if you are very, very certain, which no one can ever be of the future, but if you feel like you've got really good potential for growth, you might put more of your eggs in one basket. But what if it goes the other way, right? What if, going back to our previous examples, GE, there's nothing wrong with GE back in the 60s. It's just going to keep growing, growing, growing until it doesn't. That's pure diversification. Enron, you work at Enron in early 2000. This company, you see it from the inside. This company's great. It can only go up. I'm going to put all my 401k into it until one day it doesn't, right? So it can all go really well. Even if you look at the last 2 years, certain stocks have just really, really done well. Does that last forever? Can you have your money invested elsewhere? Do you need the most highest rate of return? Of course you want it, but in those down years, you want a little bit of protection. That's where diversification can come in.
Exactly. And so it could reduce your overall rate of return from a growth perspective, comparing different stocks, but it also is designed to protect you on the downside. So it really, it mitigates your risk. And the example that we used earlier is, you brought it up, Enron. If you owned all of your money in Enron and it went to zero, you went kaput. But if you owned the S&P 500 index and it was the sixth largest one, you might have lost 1% or 2%. On the flip side, you take a look at the S&P 500 over the last couple of years, it's earned 20-something% each year. But if you owned NVIDIA, holy smokes, you made like 600%.
Yeah.
So that's what you give up. You give up the upside, you give up the downside, but the diversification basically smoothens things out.
I notice one thing that a lot of individual investors do is they invest in things that they're familiar with. There's absolutely nothing wrong with that, but sometimes you'll see a doctor invest in all healthcare companies, a engineer, you'll see that you'll invest with familiarity, and there's nothing wrong with that. Even diversification within a specific industry is good, but it's something to be aware of. Just because you're familiar only with one area or you only really want to invest in one area doesn't mean that you shouldn't explore elsewhere. You take it to the U.S. versus international. Just because the United States has outperformed international investments every year for the last 20 years, except for one or two, that doesn't mean that you don't want to have some exposure there.
Right, exactly. The other thing, the comment goes with risk. People who don't understand the stock market view it as too much risk and avoid it. And to your point is those that do understand it are more apt to get into it. And to your point is what we've found, and you've seen it as well, people who are in the technology industry, what are they investing in?
Yeah.
All technology stocks.
Yeah.
Why? Because they know it. They know the industry and they feel comfortable with it.
Real estate agents, I'm going to invest in real estate.
That's correct. It's another good example.
Just a familiarity.
So last question, because we're almost out of time, and it's hand in hand with this, is how do I balance risk and reward in my investment portfolio? It sounds like all of the same things that we're talking about is diversification.
Yeah, you just balance all your money into the highest performing stock.
Yeah, right, exactly. That's how easy that is. All right. So anyway, we're going to be picking this back up again in the next episode. So thank you for joining us. Hope you learned something. That's the whole intent of the show. And thank you again for joining us. We'll see you next week.